In 2018, ProPublica obtained something the IRS never intended the public to see: the actual tax records of the 25 richest people in America. The results were staggering. While a typical American worker earning $70,000 a year paid an effective tax rate of around 14%, the 25 richest Americans, with a combined net worth of over $1 trillion, paid a true tax rate of just 3.4%. Jeff Bezos, 0.98%. Elon Musk, 3.27%. Warren Buffett, 0.1%. They weren't breaking the law. They weren't hiding money in suitcases. They were using a strategy so simple it has just 3 words: buy, borrow, die. Buy, borrow, die isn't a conspiracy theory. It isn't a secret offshore scheme. It's a wealth preservation strategy taught in business schools, discussed openly by tax attorneys, and used by virtually every billionaire in America. The concept is elegant. Step 1, buy assets that go up in value. Step 2, borrow against those assets instead of selling them. Step 3, die, and the tax bill dies with you. Each step exploits a different feature of the U.S. tax code, and together, they create a cycle that can last for generations. Step 1 is the foundation. Buy assets that appreciate. Stocks, real estate, private companies. Here's what makes this powerful. In the United States, you only pay taxes on investment gains when you sell. This is the concept of unrealized gains. If you buy Amazon stock at $10 and it rises to $3,000, you've gained $2,990 per share. But as long as you hold, that gain exists only on paper. The IRS cannot touch it. Your net worth can grow by billions of dollars in a single year, and your tax bill can be zero. Now compare that to a salary. If you earn $100,000 as an engineer, the IRS taxes every dollar the moment you receive it. There is no option to defer. Wages are taxed in real time. Wealth is not. Between 2014 and 2018, Elon Musk's wealth grew by an estimated $13.9 billion. His taxable income? Almost nothing. His salary at Tesla was $1 per year. He didn't sell stock. He didn't take bonuses. On paper, he was barely earning anything. In reality, he was becoming one of the richest humans on Earth. Over that period, Musk paid $455 million in taxes, a true tax rate of 3.27%. The median American household earning $70,000 paid about 14%. A schoolteacher in Ohio paid a higher rate than the man who would soon become the richest person on the planet. Not because the system is broken, because it's working exactly as designed. Step 2 is where the strategy becomes elegant. Instead of selling assets and triggering capital gains tax, billionaires borrow against them. You own $10 billion in stock. You walk into Goldman Sachs, Morgan Stanley, or JP Morgan and ask for a loan. The bank says yes. Your collateral is 10 times the loan amount. Interest rate, 1 to 3%. And here is the critical detail. Loan proceeds are not income. When a bank hands you $1 billion, the IRS does not consider it earnings. No tax event, no capital gains, no income tax. You receive $1 billion in spending money and pay zero tax on it. You can buy jets, yachts, mansions, all funded by debt, not salary. And the interest on those loans may even be tax deductible. Larry Ellison, co-founder of Oracle, has used this strategy for decades. As of 2025, Ellison has pledged 346 million Oracle shares, 30% of his entire stake, as collateral for personal loans. By 2014 alone, his credit lines against Oracle stock had reached $9.9 billion. He used the money to buy entire Hawaiian Islands. He purchased 98% of the island of Lanai for $300 million. Mansions across Malibu, a racing yacht, all without selling a single share, which means without triggering a single dollar in capital gains tax. Elon Musk pledged tens of billions in Tesla shares as collateral. SEC filings show that Tesla's board capped Musk's borrowing against his shares at $3.5 billion. The loans funded his lifestyle. The stock stayed untouched. The tax bill stayed at zero. Here's what makes this infuriating for ordinary workers. You earn $80,000 as a nurse. Your employer withholds taxes before you ever see the money. Federal income tax takes 22% on much of it. Social Security takes 6.2%. Medicare takes 1.45%. Your state might take another 5 to 10%. By the time your paycheck arrives, a third or more is already gone. Meanwhile, a billionaire receives $1 billion from a bank loan and pays nothing. You are taxed on every dollar you earn. They are not taxed on the dollars they borrow. Same country, same tax code, radically different outcomes. Step 3 is the final piece, and it's what makes the entire strategy permanent. When a wealthy person dies in the United States, something remarkable happens under Section 1014 of the Internal Revenue Code. It's called the stepped-up basis. Here's what it means. You bought stock for $1 million over your lifetime. By the time you die, it's worth $100 million. That's $99 million in gains that were never taxed. Normally, selling that stock would trigger a massive capital gains bill. But the stepped-up basis wipes the slate clean. Your heirs inherit the stock at its current market value, $100 million. The $99 million gain vanishes. The IRS never collects a dime. And here's where it becomes a dynasty machine. The heirs don't sell either. They borrow against the inherited assets. And the cycle, buy, borrow, die, starts all over again. The Walton family, heirs to the Walmart fortune, are the textbook example. Sam Walton founded Walmart in 1962 and spread his ownership across his children long before the stock became worth hundreds of billions. When Sam died in 1992, his heirs inherited the shares at their stepped-up basis. Since then, the Walton family has collectively been worth over $200 billion. They rarely sell stock. They rarely trigger capital gains. The wealth passes down, the basis steps up, and the cycle repeats. Jim, Alice, and Rob Walton have held their positions on the Forbes list for decades, not by earning taxable income, but by holding appreciating assets and borrowing against them. 3 generations deep. The strategy unchanged. In June 2021, the investigative outlet ProPublica published the most explosive tax story in American history. They called it the secret IRS files. Someone had leaked years of actual tax return data from thousands of the wealthiest Americans. Not estimates, not projections. The real numbers, straight from IRS records. The identity of the leaker was never confirmed. The IRS launched a criminal investigation, but the data was already out. And for the first time, the American public could see exactly what billionaires actually pay in taxes. Not what they're supposed to pay, what they really pay. The numbers were devastating. Jeff Bezos, between 2014 and 2018, his wealth grew by $99 billion. He reported $4.22 billion in income and paid $973 million in federal taxes. His true tax rate, taxes paid relative to wealth growth, was 0.98%, less than 1% on $99 billion in gains. Warren Buffett, wealth grew $24.3 billion. Federal taxes paid $23.7 million. True tax rate, 0.1%, 0.1%. The man who famously said his secretary pays a higher rate than he does was proving his own point with real numbers. Michael Bloomberg, $22.5 billion in wealth growth. Taxes, $292 million. True rate, 1.3%. For context, the median American household earning $70,000 paid about 14%. If this strategy is legal, why doesn't everyone use it? Because it only works at scale. Securities-backed lending typically requires at least $1 million in liquid assets, and that's just to start a conversation. The loan-to-value ratio is 50 to 70%, meaning you can borrow about half the value of your holdings. At billionaire scale, that math is transformative. At middle-class scale, it barely covers a car payment, and the interest rates are not equal. A billionaire borrowing $500 million gets a rate near prime, 1 to 2%. A regular investor borrowing $50,000 from their brokerage pays 6 to 9%. Same strategy, radically different economics. The tax code is technically neutral, but the benefits compound exponentially with wealth. politicians have noticed. In 2022, President Biden proposed the billionaire minimum income tax, a 20% annual minimum on total income for any household worth more than $100 million, including unrealized gains. If your wealth grew by $10 billion, you would owe at least $2 billion, whether you sold anything or not. The proposal never passed Congress. Senator Elizabeth Warren proposed a direct wealth tax, 2% annually on net worth above $50 million and 3% above $1 billion. That didn't pass either. The opposition argument is both constitutional and practical. Taxing unrealized gains means taxing paper profits that could vanish overnight. If your stock drops 40% the day after you pay, the government has taxed wealth that no longer exists. Critics call it taxing phantom income. Other countries are watching, and some are responding. In 2024, Norway introduced a tax on unrealized capital gains for residents who emigrate, a so-called exit tax. If you try to leave Norway with appreciated assets, you owe tax on the gain before you go. Canada has taxed capital gains at death since 1972. There is no stepped-up basis. When you die, the Canadian government treats your assets as sold at market value and collects capital gains tax from the estate. Australia taxes inherited assets at their original cost basis, meaning the gain is never forgiven. The United States remains one of the only major economies where death resets the tax clock entirely. The question isn't whether the rest of the world sees the problem. It's how long America will keep the door open. But here's the question no one in Washington wants to answer directly. Is buy, borrow, die a loophole, or a feature? The stepped-up basis has existed since 1921. It has been in the tax code for over 100 years. Securities-backed lending has been standard practice for decades. The distinction between realized and unrealized gains is foundational to the entire American tax system. This is not a bug someone forgot to patch. It is the architecture of the code itself. The Congressional Budget Office estimates that stepped-up basis alone costs the U.S. Treasury $58 billion per year in foregone revenue. Over a decade, that is more than $500 billion. But every attempt to repeal it, including a brief elimination in 2010, has been reversed under intense lobbying pressure from the wealthiest estates in the country. So where does this leave you? If you earn a salary, you play by one set of rules. If you hold billions in assets, the rules are so different they might as well be written in another language. Buy, borrow, die isn't illegal. It isn't fraud. It is the default playbook of American wealth. A three-step process that turns the tax code into an optional expense for those who can afford the entry fee. The question isn't whether billionaires are smart enough to use it. It's whether the rest of us are willing to let them keep using it forever. This is Tax Map. We show you the map they don't teach in school. Subscribe, because in our next video, we'll break down which countries are actively closing these loopholes and which ones are building their entire economy around them.